We as traders are on the market just to make a profit, right? The concept is simple and it applies on every market possible. You want to buy something cheap and sell it at a higher price to make a profit, of course. So let's say you want to buy a house, for instance. Yes, you want to buy a beautiful house with a nice loft, a nice terrace, a nice pool. So you look at the external aspect of the house, such as the comfort and the beautiness. But at the same time, you want another aspect, which is of course the value aspect. So you do your math and you decide if the beautiness and the comfort of the house is worth the price at which is listed for. Is it more expensive than what you would pay for? Or is it cheaper? And thus is a nice deal. Well, in this case, the businessman mindset kicks in, and one of course buys something that is cheaper than what you actually value it, so that one day you can eventually sell it for a higher price, or just simply flex about what a nice deal you just made. Now, the process of buying and selling something for a profit is called speculation. So you can buy a house to speculate on it, just buying it cheaper and selling it for a profit, or you can simply buy it at any value because you don't care about selling it for a profit. The first one is the speculator and the second one is the consumer. Trading as we do it is the real speculative activity. We are in the market exclusively to speculate, and make money. The key difference, of course, between buying and selling a house and trading in the forex market is the time frame. We traders work on a very much smaller time frame compared to buying and selling a house. A professional trader usually has a 1 to 3 month portfolio, but of course the forex market allows the trader to make a profit in minutes if he wants to. But let's get to the supply and demand topic. What's taught on YouTube or on the internet about supply and demand is quite funny, and it's based simply on technical analysis, which is kind of dumb if you ask me, because of course the concept of supply and demand is completely different and it goes way beyond your chart. Let me explain why. So let's take for instance a farmer that provides commodity that people actually use, such as corn, wheat, meat, dairy, or whatever. On the other side, there are the producers that take the commodity, the crude commodity, and then they turn it into sellable and consumable products for the consumers indeed. The point is that sometimes during good periods, the farmer will get an oversupply, which means that the farmers now have more product to sell because the conditions were good, so more products grew, and now they have more product to sell. And because of that, they will lower the price to sell all the excessive commodity they have and to compete with other farmers that they themselves now have more product to sell. On the other aspect, there are times of unfavorable condition where the farmers have troubles growing the commodity. So now they have less supply, and to maintain their living standards, to pay for the expenses, they have to raise the price. And so now the sellers that's buying the commodity for a higher price, they have consequentially need to raise their prices to keep the profit margin. Because if you buy something that at a certain price and then you want to sell it and then you sell it at a higher price, you have your profit margin. But if the commodity price rises, your profit margin is lower. So if you want to keep the profit margin the same, then you have to raise the price. And this is why price fluctuates because of supply and demand. But you may ask now how this applies to trading. The best example I can give you right now is crude oil. And crude oil is actually the pair that I love the most when it comes to supply and demand trading, because it's very much affected by what's going on in the world, and less supply for the oil, for less supply of course, means higher oil prices and vice versa. Now there are different factors affecting the supply of oil in the industry, and for instance one is the tension in the Middle East. But first I want to get you one thing clear, that OPEC controls 81% of world oil supply. So they have the power of cutting and increasing supply. So you gotta keep track of what OPEC is doing, because if they're cutting supply or increasing supply, that will affect the price, of course. And the Middle East is a big producer of oil, and if issues like war, civil war, rebels, whatever, then the Middle East oil producers are at risk. Thus the supply of oil is at risk. Because keep in mind that 65% of OPEC oil reserves are located in the Middle East. So you see how valuable it is. Anything put in the Middle East at risk will put a lot of oil supply at risk. So the best example is the Gulf War, where price grew so much, and from a mere $70 a barrel, 20 days before the conflict, the price went to $180 a barrel after the first month of the conflict. But how can this be applied to the currency market, to the forex? Well, central banks have the power to inject and withdraw money supply. So what happens if they inject money into the market? Supply rise, thus the value decrease. If they withdraw money, supply is cut, thus the value increase. So everything comes back to keeping track of what the central bank are doing.